Welcome to another stock investment analysis video. In today's video, I'll be showing you 5 stocks to buy for July. Each of these stocks has impressive growth histories, great dividend growth, and amazing forecasted growth. That's growth, and more growth. Better yet, all 5 of these stocks are great buys right now at current valuations. As the stock market hits all-time highs, it is getting harder and harder to find quality companies at a good valuation. I hope that my video today gives you some great ideas on stocks to invest in which you may not have been considering or perhaps even heard of. However, when you see the data that I will show you today, you will see the impressive potential each of these companies has. Before we get into that, there are 2 things I want to share. The first is the winner of the $99 subscription to DivTracker. The winner of the contest I had on my last video was Prerak Mall. Congratulations, I hope you enjoy the app, and happy DivTracking. My second announcement is that YouTube has opened up a new membership feature for my YouTube channel. Now you can become a member of my channel if you're interested. All you have to do is go to my channel page and click join. You should also see the option to join at the bottom right of this video like I'm showing you here. If you're curious on what this paid membership entails, feel free to click join and check it out. I will also explain it in this video. It is a premium or a paid membership with 4 tiers. The first tier is a Dividend Challenger tier. If you would like to be a Dividend Challenger, the membership fee is $1.99 per month. Joining the tier gives you access to these loyalty badges next to your name when you comment on my videos and gives you special emojis that you can use. The badges will change color the longer you are a member, so we will eventually be able to see who has been a member for this channel for the longest. It'll also give you access to some exclusive member-only posts I've been posting. The biggest thing about becoming a member is helping to support the channel and allow me to put more into the videos that I've been making for you. The next tier is a Dividend Contender. If you've never heard of a Dividend Contender is a company with 10 years of growing dividend payments or more. My tiers are following the theme of dividend-paying companies because that is my investment focus. Because a Dividend Contender has grown its dividends for at least 10 years, the cost of my tier is $9.99 or about $10. All individuals in this tier receive shoutouts in each of my videos, exclusive member-only videos, and investment news updates. Speaking of which, I would like to take a moment and give a shout out to my incredible members Chester Bean, Sarah Kim, James Anderson, Peter Brown, Steve Baldwin, and Angie Molini. They have been some of my most consistent viewers and were the first members to join this channel when my membership was released just a few days ago, and I want you all to know that I deeply appreciate your support. Dividend Aristocrats are companies which have paid out dividends for 25 or more years. As a result, the members who become Dividend Aristocrats pay about $25. Now, I recognize that's a lot of money to pay, but in addition to all the other prior perks, it allows you to ask weekly questions which I'll be answering in videos, which takes me a fair amount of time to complete. Those videos are posted for my members to see. Last, we have Dividend Kings, companies which have paid out their dividends for at least 50 years. The members who become Dividend Kings pay $50. I don't know if anyone is actually willing to do so, but I would be amazed and grateful if anyone did. The reward for this, in addition to all the prior rewards, is you can choose a video topic once per month, and I will create a short video for you which I will be posting to my channel. Just so you know, you can cancel your membership at any time. And don't worry, the fact I am now going to be creating some exclusive content only for members does not mean I'll be posting publicly any less. I'll still be creating videos for everyone, so again, don't worry. If you have any questions about memberships, please let me know. Alright, now let's talk about these 5 stocks. I want to start off by saying to always do your own research. I am not doing an in-depth analysis on these companies in this video because I'm giving you an overview through a fast graphs analysis on each stock for why I think you should be looking closely at these companies. You will still want to do your own due diligence before you buy. If you want me to do an in-depth analysis on one of these companies in a future video, please let me know in the comments. Our first company on fast graphs is Assurant. This is a company in the insurance industry which provides a number of insurance and extended service contract services. Now first, notice that they pay a 2.06% dividend yield, have a market cap of almost $7.3 billion, have a BBB credit rating, and a 45% debt to capital ratio, all of which are fairly positive, although I generally invest in larger companies with higher dividend yields. Looking here, you can see their average earnings growth rate has been over 11% per year for 18 years. Also important is the 46% growth in 2017, 48% growth in 2019, and continued double-digit growth between 11 and 19% expected for 2020, 2021, and 2022. We are now looking at free cash flow. They unfortunately do not have updated information for 2020, but it's important to note here that the free cash flow in green easily covers the dividend shown as the white line. The dividend payout as of the last known data was only 11.6%, which gives plenty of room for dividend raises. Looking at performance, you can see it as beating the S&P 500's performance in terms of total returns by over 3% per year. The dividend growth rate has been 17.7% per year, which is also excellent, and you can see that they have consistently kept the dividend payout ratio low. So we know that past performance is great, but what can we predict about the future? Looking at FastGraph's forecasting calculator, you can see that at a fair valuation of 15 PE, we could expect over 21% in annual returns until the end of 2022. If instead of fair value, it returns to its normal PE of almost 16, we would instead see greater than 24% annual returns. Anything over 20% is amazing in my opinion. Next, we look at Anthem Incorporated. Anthem operates as a health benefits company in the United States. The company offers a range of network-based managed healthcare benefit plans to large and small group, individual, Medicaid, and Medicare markets. Looking at this chart, we see a dividend yield of almost 1.4%, a market cap of almost $70 billion, an A credit rating, which I always like to see, and 36% long-term debt to capital. Impressively, we see this company is growing at 16.44% annually for the last 20 years. Earnings growth over 15% is excellent. When we take a look at free cash flow, we can see the dividend is easily covered. By the end of 2020, free cash flow is expected to be at $17.12 per share, whereas the dividend is only $3.80. This gives us an estimated dividend payout ratio of only 22.2%. Next, we look at past performance. Over the past 20 years, Anthem has returned over 15% per year to shareholders, which is amazing and over double the S&P 500. $10,000 invested 20 years ago would now be worth over $142,000. When we compare that to only about $37,000 from the S&P 500, you can see the power of compounding. Anthem would have given you nearly 4 times more money. The dividend growth rate is at 15.6%, which is also excellent, although it has only paid the dividend since 2011. You can see they have also consistently kept the dividend payout ratio low, which means that the dividend is safe and has room to grow. Because of how fast they've grown the dividend, if you'd invested back in 2011, your yield on cost would now be 15.3%. That's amazing for a company with only a 1.4% dividend yield currently. Looking to the future, if the company remains at a fair value of 15, we would see 21.6% annual returns until the end of 2022. Because the normal PE is also about 15, we would see nearly the same return if the share price returns to its normal PE ratio. Next, we have L3Harris Technologies Incorporated. This company is an aerospace and defense technology company which provides mission-critical solutions for government and commercial customers worldwide. The company is based out of Melbourne, Australia. The company has a dividend yield of almost 2%, a market cap of almost $38 billion, a BBB credit rating, and a 23% long-term debt-to-capital ratio. During the last 20 years, they have grown their earnings at over 16% per year. Notably, the company is expected to grow earnings by 37% this year, after a 28% increase last year. They expect 13 and 16% earnings growth for the next 2 years. Looking at free cash flow, you can see a massive spike of 252% in 2020. That's a massive increase and is expected to be followed by a 16% increase in 2021 and 13% in 2022. By the end of 2020, the dividend payout ratio will only be 28%, which gives us plenty of room for growth. Looking at past performance, over the past 20 years, L3Harris has crushed the S&P 500 by nearly tripling its annual returns, with 14.2% compared to only 5.7% for the S&P 500. As a result, the $136,000 in returns from L3Harris over that time would be more than 4.5 times more than the $30,000 from the S&P 500. L3Harris has grown its dividend by over 20% per year on average, which is very impressive over such a long period. If you had invested back in 2001, your yield on cost for that dividend would now be a massive 19%. A 19% dividend that is very safe with such a low payout ratio is beautiful. Now, looking at the forecasting calculator, if the share price remains at fair value, we should expect to see 17.64% annual returns, given the expected earnings growth of 13%, 16%, and 11%. If it returns to its normal PE of almost 20, however, we would see closer to 22% per year. I'm always happy for returns like that. Now we look at Nexstar Media Group. This is a television broadcasting and digital media company in the United States. The company focuses on the acquisition, development, and operation of television stations and interactive community websites in small and medium-sized markets, and offers free over-the-air programming to television viewing audiences. The company has a dividend yield around 2.5%, a market cap of just under $4 billion, a BB- credit rating, which is lower than what I prefer, and a 78% debt-to-capital ratio, which is higher than I prefer. Now, as you can see, this company had no earnings to speak of until 2012. However, the share price has not closely followed the earnings, and earnings appears to be a poor valuation metric for the company. When we switch to earnings before interest and taxes, or EBIT, we can see that the share price follows this metric much better. EBIT growth has been 23.56% for the past 19 years. They're expecting a massive 105% increase in 2020, followed by an 18% decline, and then another 31% increase. If it returns to fair value where it has typically been for the last 19 years, and the forecasted predictions are accurate, we could see over 40% in annual returns until the end of 2022. That would be spectacular. Now, of course, bear in mind that this is based on the assumption that EBIT is as forecasted and that the price remains at fair value. We can't say for sure whether this will occur, but 40% annual returns is certainly enticing. Free cash flow shown here is expected to experience explosive growth this year in 2020, going up by nearly 400%. As a result, the dividend payout ratio is only at 9.8%. They project a 4% decline in free cash flow for 2021, but another 35% increase in 2022. That's massive but dwarfed by the increase for this year. Looking at past performance, we can see that this company's total returns for the last 19 years was 12.4% per year compared to the S&P 500 8.1%. That performance basically dealt with the S&P 500 in terms of the $70,000 investors received compared to the $36,000 from the S&P 500. The dividend growth rate is a beautiful 24.6% per year, although it has only paid out a dividend since 2013. We are now looking at the forecasting calculator on FastGraphs using EBIT to forecast future share price. If the share price returns to the normal price to EBIT of about 8, we would see 30% returns until the end of 2023, which is amazing. If it returns to a fair value of just under 7, we would see returns over 25% every year. Last, we see United Health Group Incorporated. This company is a diversified healthcare company in the United States. It offers consumer-oriented health benefit plans and services for national employers, public sector employees, mid-sized employers, small businesses, and individuals. They provide access to networks of care providers as well as software and information products. The dividend yield is 1.58%. The market cap is very large at over $300 billion. It has a beautiful S&P credit rating of A+, and a 36% long-term debt-to-capital ratio. Impressively, it has an 18.3% annual earnings growth rate. Recent years were particularly impressive with growth of 25%, 25%, and 28%. The next 3 years, including this one, are expected to have 9, 12, and 14% annual growth. When we examine free cash flow, we see that the dividend payout ratio is impressively only at 26.4%, which gives us plenty of room for growth. It's also great to see a free cash flow growth rate of almost 16% for 20 years. United Health Group has the most impressive history of the 5 companies today. It has returned on average 17.3% per year for the last 20 years, well over triple the S&P 500. $10,000 invested 20 years ago is now worth about $231,000. That's approximately 7.7 times the amount you would have gotten from the S&P 500 for that same time period. The compound annual growth rate has been an insane 44.5% for the dividend, with only double or even quadruple digit growth since 2010. The yield on cost for anyone who invested back in 2000 would now be an amazing 28.2%. Now, United Health Group's PE is currently a bit high at around 20. FastGraphs considers 15 to be fair value, so if it returned to fair value by the end of 2023, we would only see around 5% annual returns. However, United has traded at a premium for most of the last 5 years, and I believe we will continue to see that. The normal or average PE for United is actually around 17.6 for the last 20 years, and over the last 5 years, the PE has been closer to 19.23. If the share price remains there until the end of 2023, we could expect around 13% annual returns. I hope you enjoyed this video and this has given you some ideas for investing and further research. If you want to support the channel, please consider becoming a member and joining our community. Don't forget to subscribe because I'm creating more videos for you every week. As always, good luck with your investing.